All right, good afternoon, everybody. Welcome to the weekly take on the market. Today is August 4th, 2023. It's Friday. The market just closed. It is 1:07 my time. I am on the West Coast. So sometimes people ask when I talk time on IBD Live. The market is open from 6:30 in the morning till 1 o'clock for us. Most of you probably know that, but it's actually not that bad. You kind of get used to it after a number of years. And it's nice that, you have the afternoon that you don't have to worry so much about your positions. I once thought about living in Hawaii, what that would be like. And sometimes the market opens, I think, at 3:30 in the morning Hawaii time. So that's a bit early. So, and I know we have a lot of subscribers in Hawaii, but I'm sure they make it work. We have a lot of people overseas and international too. I'm sure they make it work as well. All right, so I apologize. I got off topic a little bit. So this is your weekly take on the market. I'll be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I am not licensed. Don't make buy, sell, hold recommendations. I do like to disclose if I am long, short, something, just because, I think it's important to know if I'm talking about XYZ and have a position, consciously or subconsciously, I could be talking my book is what they say. So I think it's important to know that where I am positioned in some of the names that come up, but I'm not saying that you need to be long, short, or out of that position. Okay, market thoughts. You know the drill. So we'll start with the market thoughts. I do have just a couple of slides. I did take last week off, so I just have a couple of slides, I think, for this week, and then we'll get into the indexes. So here is a chart from Highmount Research, NAAIM exposure. I have heard of this, but I don't. National Association of Investment Managers, maybe something like that. So I'm not 100% on how they create this index of sentiment. But you can see that this is the highest exposure. And I took this screenshot last week when they tweeted this. So this is the highest exposure since the high. The 108 mark was where the S&P made its high. What is that? Almost 2 years ago now, or something like that. So it's not extreme, but you're pushing this kind of upper bound of where you can get into spot of bother historically. This was great. Somebody tweeted about the Federal Reserve, and it's on everybody's mind. It seems like we're talking about the Fed every other day, and the bond market, and Fitch downgraded the U.S. debt, and it's just story number one recently. And they tweeted that the Fed has 400 PhD economists. So they have over 400 of the smartest, sharpest men and women in the nation. And with all due respect, if they don't know where if they don't know where the economy is going, then how could I possibly know? And that's the story here. So I think that's why it's so important to understand price and volume and what the market is telling you. Stanley Druckenmiller says the best economist in the world is the stock market. And when everybody late last year felt like we were, the yield curve had inverted and we were looking at a recession for sure, it never came, at least not yet, right? And the markets had gone gangbusters this year, especially because what happened? A lot of people had prepared for this recession, and so they weren't positioned for an economy that kept doing pretty well and inflation that was coming down. And so the market went up without them, so to speak. So it's most important to follow price and volume. That's what Bill would say. So I think that's it. Okay, let's pull up the indexes. I have a chart of Apple up. I'll get to Apple, but that might as well be the index, right? So let's pull up the NASDAQ first. So we're 12 minutes in. So this volume bar and the price bar will be a little bit behind. I don't know if it'll turn out to be a distribution day. Volume was pretty high yesterday, so it's probably not going to surpass that. But wasn't a great day. It looked like it was going to be an okay day. On the market was shaking off the Apple news. Apple didn't act well on its earnings report, but Amazon was up big. And so the market, at least early, seemed to ignore Apple and was okay. It was acting all right. And it was actually a pretty good sign. I actually covered some of my shorts this morning because I thought, well, if it can't go down on a bad Apple number, how's it going to go down? And then about halfway through the day, I would say around 10:30-ish my time, so roughly 2/3 of the way through the day, you had a break. And I know there was some talk of a cyber attack on some hospitals, et cetera. I didn't really get much of that story. Again, I don't know what good it would do me to dig into the story. I'm not a cybersecurity expert. Just watch the tape. And the market, if that's the reason, quote unquote reason, the market didn't like it. And it was weak, like really weak and very heavy all day at that point. So I had to put what I took off, I had to put back on. That's why I always move in increments. I don't like to make all or none decisions because you don't want to put so much pressure on yourself to get it so perfect, so right. So it wasn't a great close, and so I think I counted on IBD Live on Wednesday. This was like a undercut of a 15-day low on the NASDAQ. And I went back and counted just kind of in real time while I was on the show. And if you haven't had anything quite like that, here you've got, so let me refresh this so we get rid of this. So you got like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So you got like a 10-day low undercut there, which was quickly resolved to the upside. And here you have, well, let's say about there. So you have 1, 2, 3, it's about a 6 or 7-day low. See, the market's been holding these lows so well. It's just been so methodical to the way up. And this is the first time it's changed a little bit. I don't think, for what it's worth, you need to rush out and be all bearish, but I would say, and I've been saying it and been wrong a little bit last couple of weeks, is batten down the hatches is how I would perceive it. If you live on the coast, Florida, New Orleans, I've never lived anywhere like that, but I imagine if you get a hurricane warning and you batten down the hatches, you prepare, and most of the time, probably nothing bad happens, but you're going to do that over and over. I've lived in my house almost 25 years, I think. And there's a huge kind of hill over here that can get really dry. And we've had some fires in those 25 years where I could look out my bedroom window and see flames. And I've, packed up the house, computers, pictures, all the stuff that, you don't want to lose, and stuffed it into my cars. And I've done that twice in the last 25 years, and both times were false alarms, but I'm going to do it again. It's okay. It's a false alarm. It cost me a few hours of work, but that's the way it is. So I would, hear from a portfolio standpoint, batten down the hatches. You don't have to sell if you don't want. If you're having a good year and you want to try to ride out the storm, I think you've earned that right. Probably, I know I wouldn't own anything that I was down on unless I just bought it a day or 2 or 3 ago. But, if it can't go up, if you've owned it for weeks to months and it can't go up in that, what's going to get it to go up? So there's a saying in the markets that even a turkey can fly in a windstorm. And we've had a little windstorm here. And so if you have stuff that should go up in a NASDAQ rally and it hasn't, I would be out of that. Now, you might have these special situations, or maybe you own I'm just going to make some, gold miner or uranium stock. It's not going to be correlated to the NASDAQ. So that might be a different situation of how you want to handle that. But, Google, Datadog, ServiceNow, what else has struggled? HubSpot didn't have a great report. Depending on how you own these, I would be down to a core. You want to own NVIDIA, you want to own SMCI. What else is acting great? Melly. I'm sure there's plenty of others, but you get the idea. So I think the jury's out on the NASDAQ. We'll have to wait and see. It could be, potential storm, but it's, we're still above the 50-day, but we are below the 10 and 21, which is the first time since here. I think this is kind of the banking crisis low, or no, maybe this is the banking crisis low. I don't know what happened. I can't even see how quickly you can forget. I don't recall if there was any kind of event-driven reason for why the market kind of a bad day right there. The S&P looks very similar. It's 1.6% above the 50-day. And then the Dow looks a little different. Like it just doesn't have any oomph, the Dow. I don't really watch the Dow that often, but it just doesn't go anywhere. It just has it. Look at this. I mean, let's pull up a weekly. I mean, I like to always go back and say, like, where is, avoiding dividends, regardless of dividends. So where are anybody that's kind of happy that they own the Dow? And maybe a few lucky ones in there, but really it's since like late 2021, and it's not up that much. So there's a reason that Bill chose to remove it from the big picture as far as calling follow through days many moons ago. Gosh, probably did that 15 years ago, maybe longer. I can't recall exactly when, but they don't use this to call follow through days anymore. It's S&P and or NASDAQ. Once in a great while, maybe the Russell, if they absolutely have to. It's kind of a weird market environment, but it's usually NASDAQ and S&P. The Russell, since I mentioned it, very Dowish, just doesn't go anywhere. Just doesn't go anywhere. It's a hard time putting on points. International. So let's look at EMXC. I thought this would get going again. It's just every time they look good, they go back down. So not that great. Emerging market EEM. Same thing, broke out, turn on the pattern rack, broke out. Now it's kind of giving it all up. China, it looks like it's possibly trying, but I don't own any Chinese stocks and haven't for a while, but maybe, and they have a lot of bad news, which is good, right? The crisis creates opportunity. It's good in the fact that the bad news is out there. If you know what the bad news is, it's probably 80% or more priced into the market. It's what you don't know that's usually get you. All right, so let's go to the industry groups. Did I cover all the indexes? I think I did. I did most of them. So computer hardware, this is SMCI. It's such a monster stock, so strong. It's driving this group. Semiconductor fabless, we know what stocks those are. Software database like MDB, maybe I haven't looked at MDB in the last few weeks. It gapped up on earnings. It's holding that gap for a long time, but it's crazy to me that So it gaps up on earnings, and then in 27 days, let's pretend it's 395. So in 27 days, you got to fade another earnings report. And if you bought the gap on earnings, you have no cushion. This is the problem with earnings, trying to stay out of them for earnings. It's just so tough. But being in for earnings is tough too, right? If you were in MDB here, it gapped down. If you wanted to be in and weren't, it gapped up. FTNT had a terrible day today on earnings. VRT had an incredible day a few days ago on earnings. It's really very difficult on how to handle that. Building maintenance and service. I'm on a call. Building residential, commercial, housing, internet content, computer software. So like I said a couple of weeks ago, I like the constituency of the groups. I don't think that's the right word, but the makeup of the groups. I think there's growthy groups, there's CanSlim type stocks in these groups. So that the groups has not been a problem for the market. It's been fine. There's been plenty to own. You can even be, diversified. You can, if I went through this and you owned SMCI, you owned NVIDIA, you owned MDB, you owned, I don't know what would be in that, but you owned Pulte Homes, Building AC. I don't know exactly what would be in there, but internet content. So you'd be pretty diversified, not totally diversified, but not terrible as well. So let's go to stocks. Let's start with like FTNT, which gapped down on earnings today. And the earnings were good, I guess, on the surface. I don't own this one and haven't been in it in a long time. So I'm presuming the guidance was very poor, and that's what led to the weakness. And it's a bad day. Gosh, 25% in one day. Oof, that's tough. I feel like I've talked about, how do you handle something like this? I think you want to get in motion. So I know they were talking about on IBD Live, and so it's going to be very difficult. I know, I've been there before, but you need to hit the bid with at least some of your shares immediately, and hope it's a terrible sell. So if you have 1,000 shares, you need to sell 200-300, let's say, at 61, right on the open. And if it goes straight back to 75, you still have 700 shares. You're going to be upset, but I'm going to tell you, you're going to be, the reality is you should be ecstatic because you had something down really bad and it came all the way back, and you still have 70% of the position. If it keeps getting worse and worse, let's say I sell 300 to 61, then it's 60, then it's 59. I'm getting in motion, right? You should do more of what's working and less of what isn't. So if that sell at 61 is working, it was a good sell because the price is going lower. I need to do more of that. So then I'm going to sell another 300 at 60. And then I'm probably just going to puke the whole thing up at 59, because at that point, you really know it's probably not coming back. You're an hour into the trading. So that's how I handle them. Again, I know it's not easy. It's not easy, but you have to think about the fact that if you're wrong, if you make a bad sell, all the better, because you still have the balance of your position. So that's how I've handled them forever. And most of the time, 80% of the time, this is not a bad sell. But 80% of the time, I'm selling lower and selling lower. But it has happened to me where, I hit the bid at 61 and then 5 minutes later, the stock's 69. It's like, well, gosh, that's incredible. But I still have the balance of the position, and then I can maybe either get out of it or maybe it's just a shakeout. And the further it gaps down, the more likely it's not a shakeout. When it gaps down 15, 20%, that's not likely a shakeout. It takes tremendous selling pressure to get a stock like Fortinet to go down 20%. There are institutions that just want out, and there are no institutions that want in. So that's how you get this mismatch of price situation like that. So Palo Alto kind of in sympathy, because industry groups, the stocks, they're like birds, they flock together, and it gapped down in sympathy. And I would say if you had Palo Alto, it's the same thing. So, you're out of a third of it at 225, and then maybe you're out of another third at 220. And then, I don't know, at 215, maybe you sell it, and let's say you decide to puke it up at 215 and it runs back to 220. Well, your average cost is 225, 220, 215. If you did third, you're out at 220 on average, same price that it's at. So, no harm, no foul as far as if you waited all day. So you can see how it's kind of like a VWAP. You're kind of creating your own VWAP trade when you do this. So this group, and then there was this cyber attack allegedly, or something happened, but yet these stocks you would think would Zscaler did, nothing happened in this group. So the guidance on Fortinet was just so poor, just swamped these stocks. Let's get to Apple. I am short Apple. I shorted it in the after hours yesterday on the earnings, and the stock couldn't go up, and it looks a little tired to me. And this is the first close below this 10-week line since I think this week, late December of last year. This in pretty much the entire year. So just outside of the early part of January, the entire year, Apple has lived above this 10-week line and, broke below it. Now, the volume wasn't tremendous, and it is Apple. And so that's both good and bad. The reason I'll say that is they're not getting bought out on Monday. It's not going to gap up 10% on me on Monday. I might not make a zillion shorting Apple, but that's fine. It's a proxy for the market, and it just looks like if the market goes down, to me, it's going to go down more than the market. And if I'm wrong, then I can easily get out. So that's partly why I like shorting some of the big liquid ones versus, and I have shorted some of the others like Carvana and UPST. And when they work tremendous. But when they don't work, you get run over. You almost always get a stop larger than you expected. So the risk reward is much broader for those types of stocks. So that doesn't look very good. Amazon though had a pretty good day, up 8%, although it was up a little bit more. Earnings up 425%. Let's go back to Apple. I mean, look, this is just not that compelling, these earnings and sales. Now, I'm not a equity CFA analyst, but when I just see this is just all so pedestrian at best, and has been for a while, and the stock went up 40%. But look at the slowness of these numbers: 70, 25, 9, negative, barely up, negative, flat, barely up. And look at the revenue. The revenue is just slowing down immensely. What's that? 1, 2, 3, 4, 5, 6, 7, 8. It's not quiet, but it's almost 8 quarters in a row of decelerating revenue growth. So it just looks like the economies of scale are catching up with them. No, that's my 2 cents, if it's worth anything. We always want to look at NVIDIA. I do have the tiniest of position in NVIDIA. I really am. It's a very strange feeling. I really am rooting for it to go down. I thought we had a chance yesterday. Was it yesterday? Yeah, it was indicated like 427 in the morning. Was it? It was. I was hoping that, and it's weird, the market rarely does this, but you have a bad day like this, and then you get like those bad opens. We don't get those anymore. I can't explain why, but we don't get those anymore. I used to love those. You get a bad day right here. Where's the follow through? It gives me a chance to buy the shakeout. Get a bad day right here. Where's the follow through? You just don't get those days anymore. There must be something to it, whether it's the everybody is so in tuned with the market versus 20 years ago. The machines, maybe the algos. I don't know what it is, but you just don't get that kind of follow through that you'd used to get. And it was one of my favorite ways to trade, is to find something that was strong and then buy it into, like a gap down on weakness reversal. But I don't know. I can't remember the last time I've done a trade like that. It's just very, very rare. It's very difficult. So this stock I would love to break the 10-week and then go back up. That's how I'd prefer to buy it, but I might be running out of time. Earnings are 19 days away. So keep that in mind I know a lot of you are probably in NVIDIA. What's your plan for NVIDIA 19 days from now? Alex Marenko was on IBD Live this morning, former portfolio manager William O'Neill, and he says he always sells some. I mean, it's probably not a bad strategy, but I've never traded with Alex, but he seems like he holds much better and longer than me. But so he's sitting through these earnings reports, but he is reducing the position to help you to overcome the volatility. NVIDIA, DraftKings, how did that end? I do not own DraftKings. So not a great day. Maybe the market kind of overwhelmed it a little bit, but this has been a very good stock. And I wouldn't read too much into this if you want to hold it. The earnings are very good. Melli a few days ago had a really good report. I really like the concept of Melli. I like the idea of Melli. It's just a very difficult stock to trade. So if I do that kind of thing, you can see that just kind of in the last few years gone nowhere. Now there's been spots to get in, and if you like to buy weakness, this is your kind of stock. On the oil and gas side, which is my favorite area for whatever it's worth right now, Valaris, you get the little shakeout on the earnings report. So I think this is a handle. I don't know if Marcus will see this as a handle. 1, 2, 3, 4. Needs to stay below that for at least one more trading day. On the weekly, it's not a handle because it turned blue. So I wish this had been, actually, I am in this one, but I wish it had been red. So you end up with a little handle there. So you don't quite have a handle, but this group is acting really strong. So here's Noble up 1, 2, 3, 4, 5, 6 weeks in a row. Tidewater, which is another position that I have, earnings next week. Let's see how that plays out, but very strong, holding up pretty well. And then on the shipping side, these stocks are holding up okay. I was in TNK, but with the weakness in the market, everything I had started to come in. And this bar is not my favorite bar, obviously. So I did get out of this, but it's high. I will reconsider. I do like this group. I don't know why, but I think it's these huge earnings and sales. They're just massive. Now, they are very cyclical. So historically, you probably want to buy these when the earnings and sales are poor. Somebody mentioned that to me on IB Live, and I said, yeah, I can't disagree with that observation. It's definitely food for thought, but it feels like that maybe something is different. I don't know. This is a long time of pretty good earnings and sales. But keep that in mind that normally these are pretty cyclical. So like Sting, you want to buy it when it looks like this and sell it when it looks like this. March of 23 is, right in there, right at the top. Losing money, revenue down 33%, September 21. Where's that? Here. So it'd have been tough to buy. You know, for me, I'd get stopped out, but that's historically how they trade. So two more, VRT. So this is a great one. This stock made my week for sure, gapping up. I did sell the gap up just because I don't know. I sold part and I sold part, and I really wanted to hold some, but it was just such a good day as stock was up 29% on the day. Now, this is the issue. The earnings were up 360%, up 24%. Now, how do I get back in if I do? So I just am fine. I cannot find a precedent for something like this. Like how to, like it's just 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. It's like 16 weeks. And the worst week is 2.5%. And the second worst week is 0.5%. Incredible. Just such a, and this is the value of watching stocks, observing them, the old fish story with Bill. I just would, you know, I did trade this somewhere in here the very first time. I was not in it. I didn't even know it existed till it gapped up, and I got the alert. So, and then I sold it somewhere in here, and it just doesn't. It just doesn't want to go down. You know, you go down for 2 days, go down for 1 day, go down for one day. So I bought it back at a slightly higher price. So it's the value of just being there and observing these stocks and recognizing that unusual strength. So if you own this, congrats. I don't know. I'm just gonna scour my model book stocks for a precedent or two. You know, when you get something like this, you know, this big monthly bar from 8 to 35, what's that, a fourfold move? I think it's probably going a lot higher, but how it gets there is so key. So this is my my project for this weekend. And then Tesla. So one of the cool things about working where we work is I've met just some incredible market minds and stuff. David Ryan, of course, and he texted me and said, you know, what happens if Tesla breaks the 50-day? Looks like it might even be forming a potential head and shoulders. So I'm guessing that's what he sees is this is the left side, this is the head. And then, you know, what happens over here, that's kind of what a head and shoulders would look like. He didn't say whether he was short or not. I'm going to guess he's definitely not long. I am short Tesla, just for full disclosure. And I think it's going lower. I think it's a great car company, and that's that. So, but we'll see. And you don't have to at me. I know a lot of Charles and a million other people have made a ton of money in Tesla. So congrats. I think that's great. And really the reality is this isn't a game about being right. It's about making money. So if you've made more money in Tesla than I have, that's the way to do it. I want to make money. I don't want to be right. I really don't care. If Tesla turns back up and just moonshots, I'll buy the thing. I won't, or I'll definitely cover it. That's for sure. In the way you keep scoring this game is just, you know, putting dollar signs. That's all that matters. I don't want to be right about Tesla. The reason I like to trade Tesla is I think the risk reward is skewed. If you get it right, it can go down a lot. The same reason I think that the longs like to trade Tesla is because if they get it right, it can go up a lot and has gone up a lot. It's gone up tremendous amount in the last few years. So it's a very it's a great bull bear debate. And if I could fast forward in time and I was only allowed to see the chart of one stock, even if I couldn't trade it, even if the rule was you can't trade it, I would love to see what Tesla looks like in 2027 or something. I just think it'd be fascinating to see how this all plays out. So, I am short FANG, which is Tesla is a component of it. And I did notice this. It's funny that David said that about Tesla. I didn't see that in Tesla, but I do see it here in this FANG index. Now it is a triple levered ETF, so that will skew the price action a little bit, but this looks a little head and shoulder toppy-ish to me too. And so that's how it's, technically would play out, but we'll wait and see. So today it gapped up a lot. I think it was up over 10 points at one point because Amazon is in here as well, but it didn't close very well. Okay. All right. So those are the stocks. Boy, I might have, let's go to, the quote of the week. Is there, I feel like there's no other stocks I want to talk about. I feel like I missed one, but, oh, SMCI. Let's pull up SMCI. Great stock. If you don't own it, study this. This is one. So when you get this type of power, the best stocks are the hardest to buy. Like you get this kind of power, it's up 30%. Who knows? This might be VRT-ish, right? It's up 30%, and then it just won't go down. That's the best ones to buy. And then it gaps up here and just won't go down. Maybe this is how, but eventually you do get this kind of first correction. And almost always you probably want to buy in these really super big leaders that first correction. So I did buy SMCI somewhere in this blue area, but then I sold it on when it broke above 270 and change. It looks very high tide flaggish, and it might turn out to be the best high tide flag in the modern world that we've had. We just don't find high tide flags too often. So it's at least if that's 270 to 338 so far from that quote unquote high tide flaggish pattern, it's up 23-24%, something like that. But a great stock to study if you don't own it. And if you own it, awesome. Some of you out there I know do, and you've done great with it. How would you handle something like this? I guess if you're looking for weakness, then you wait till it breaks the 10-week line. If you like to sell into strength, I think that it's that strength is here. This is your sell into strength, although it can get more sell into strength. You've seen it with like Qualcomm and Taser. Those are probably a couple of I can't remember the name of Taser now, but probably a good couple of examples to go back and study. But remember, those are very, very, those are like unicorns, very unusual action. So you have to keep that in mind that, when you get something like this is not typical of what stocks do. You just have this incredible macro time, the market environment, and then the company. And maybe you have that with SMCI. It's possible. It's not impossible or that's the case. But so that's another great one to study, SMCI. If you don't already own it, figure out why. I know why I don't own it is because I like to sell into strength, and stock won't pull back after I got out of it. And I don't necessarily have to buy it at a cheaper price. If I sell it at 300, it's not like okay, as soon as it goes 290, I'll buy it. I'll pay 330 for it or 400. I don't care if I think it's going higher. but I'd like to have some kind of setup. So I need some type of setup, a shakeout, break below the moving average, back up, something like that. Okay, sorry about that. So the quote of the week is very short. Aswath Damodaran. I apologize to him if I butchered his name. He's a professor at NYU. He's known for, valuations. He's often will go on CNBC and talk about, valuation, which is not something that I do, but I'm always willing to be open-minded and listen to what they have to say. But he did say something very behavioral, which I found fascinating. He said, the most important investor to study thoroughly is yourself. So we all want to be Bill O'Neill. We all want to be David Ryan. We all want to be Charles Harris. We all want to be Stanley Druckenmiller. I can go on all the guys that I've tried to emulate through my career. But in the end, I have to be myself. And I think I found that I've done better as myself than trying to be Bill O'Neill or trying to be David Ryan, et cetera. We all have strengths and we all have weaknesses in the market. And so I think there's two ways to tackle that. Like Bill would probably say, build your weaknesses up, like what Vince Lombardi would say. Find out what your weaknesses are and build them up. And that's fine if you can do that. But I also like Scott Ramsey from Hedge Fund Market Wizard says, do more of what's working and less of what isn't. So if you find stuff that you don't do well, I think it's okay to just don't do that. Just ignore that. You don't have to try to get better at that. Just stop doing that. There's a million ways to make and lose money in the market. And so I find what I do well, and I just try to focus on doing more of that. And what I do poorly, I try to stop doing that. Once in a while, I'll do something like that because, we're human. We see something, the shiny object or whatever, but mostly I stick to what I do really well. Take risk when the going is good. I like to take some off, like a smoother equity curve that hurts me when things are going crazy to the upside, but it allows me to, I just think survival. If you just stay in the game, be there. There's going to be another great bull market. There's going to be another one and another one and another one. The market ain't going anywhere. So you have to survive. And that's the hardest part. If you don't survive, you don't have any equity to play, then it doesn't do you any good. You could be the greatest stock picker in the world if you've blown up your account previously. So study yourself, know what you do well, do more of that, know what you do poorly, do less of that, or another way to do it is get better at it. Slowly but surely get better at it. But you definitely want to study yourself. You should keep track of your trades, whether it's a journal or whether it's electronically. I download all my trades into a software, and then I can sort those trades by biggest wins, biggest losses. I know what my average win, my average loss is. How often do I win? How often do I lose? And things like that. And I can go through and see all the tickers, and it's crazy how quickly you forget some of these trades. You're like, oh, I forgot that I made money in that, or I forgot that I ignored my stop in that one and lost a bunch, 6-9 months ago or whatever it might be. Okay, thank you guys. I appreciate your time. Have a great weekend. Marcus Smith at investors.com, 800-424-9033. Take care, everybody.